Good morning. My name's Karen McWilliams and I'm the Ethics and Sustainability Leader at Chartered Accountants Australia and New Zealand. I would like to thank you all for joining this webinar on the significance of climate-related risks for business, presented by the Climate Disclosure Standards Board for members of Chartered Accountants ANZ and ACCA across Australia and New Zealand. As you will have noticed, we have had a significant amount of interest in the webinar, nearly 1,000 registered, and so as a result it was moved to a different platform in order to accommodate the numbers involved. We will have a live poll open shortly. Denise, have you got that? Lovely. And the poll's just to give us a bit of an indication of your current level of awareness of climate-related risk disclosures and the TCFD. We will have the results of this shortly, and this will give our presenters a bit of an understanding of your level of existing knowledge when they go through their presentations. It's quite possible that we will have quite a broad range, so we might not be able to tailor it specifically to each of you, but we will make sure that all of your perspectives will be covered. Questions can be submitted through the chat function at any time during the presentation. We will answer as many as possible at the end of the presentation. We will have some time for Q&A then, so please feel free to put them through at any point. So I'll just give you a few minutes to give us your level of understanding at the moment, and then we'll have those results shortly. So I'd now like to introduce Simon, our first presenter. Simon Messenger joined the Climate Disclosure Standards Board as Managing Director in 2017 with over 10 years of academic and professional experience in sustainability and non-financial reporting. Simon has also worked at the Energy Saving Trust, PwC and Deloitte, focusing on a wide range of sustainability, risk management and non-financial reporting issues. Welcome, Simon.
Thank you very much, Karen, and good morning, everyone. So today I want to give you a high-level overview of the TCFD recommendations that demonstrate the corporate investor and regulatory actions which are taking place, which are linked to it, as well as give you a bit of an overview of the current sustainability reporting landscape and how all of this maps together. To start off with, many of you may not be familiar with my organization. So the Climate Disclosure Standards Board, it was set up a decade ago. It's a non-profit based in London, and our core mission is to ensure that companies value and report against natural capital in the same way as they do for what has historically been referred to as financial capital. So in effect, what we do is that we help create the technical landscape for companies to translate their environmental information into sustainability information. And I'll come back to what that means in a bit more depth later. And this allows companies to provide decision useful information to the market via the annual reports. So we are a consortium of 9 environmental and business NGOs, and the majority of our work historically has been focused on technical work. So we have a global reporting framework, which can essentially be viewed as an accounting standard for the sustainability information. Also, we do regulatory engagement, which I'll come back to later, and we work with companies to get them to understand why all of this information, this sustainability information, is material information to their business. For those of you who know about the TCFD, this will sound very familiar, and there's a good reason for it, which is that a lot of the work of the TCFD builds on our historical work, and our framework is the most referenced document in the recommendations. So the Task Force on Climate-Related Disclosures, TCFD, both Sarah and Paul will be going into much more technical depth throughout this webinar. But to set the scene, for those who know less about it, it is an industry-led initiative by the G20's Financial Stability Board, and it sets out a series of technical recommendations for companies to adhere to in order to disclose the material environmental information and the impact on the business in their mainstream report, which is also known in different countries as the annual report. Now, the recommendations are just over 200 pages long, so I'm going to be distilling it quite a bit here. But, some of the main points to know from it is that it's a voluntary initiative. There's nothing mandatory about it. And it asks companies to disclose their transition risks, for instance, regulatory risks and opportunities, as well as physical risks and opportunities, which are more traditionally known like flooding and droughts and so forth. Information can be both qualitative and quantitative, And it should help investors and other stakeholders understand how the organization is managing climate-related risks and opportunities, what the governance processes are, and how sustainable, from a financial perspective, the organization's strategy is in a world where carbon emissions will be capped to limit global warming to 2 degrees. And one of the big differences between this approach and wider sustainability reporting initiatives is that this is really about getting companies to report, measure, and manage what is strategically material to their organizations. And in the next slide, I'm going to show you, the difference between what was traditionally, viewed as sustainability reporting and what we're talking about here in terms of the annual reporting. So this is a crude simplification, but historically, sustainability reporting has been about the impact a company has on the environment. For example, in this situation, this may have appeared in the report. This company produces 100,000 tons of CO2 per year, and there's scope 1, 30,000 tons, scope 2, 50,000 tons, scope 3, 30,000 tons. And that's the impact the business has on the environment. In annual reports, what we want is for companies to report the impact that the environment has on the business. So in this exact same example, what we would now be saying is that the company is producing 100,000 tons of CO2, which with a carbon tax of $50 per ton from 2020 would create a previously unrecognized material financial risk of $5 million per year from 2020 onwards. Now, if it is financially or strategically material, it should get reported. If it's not, which $5 million per year may very well not be for a lot of companies, and this is just a made-up example, then that's absolutely fine. And the exclusions should be noted. The whole exercise and the whole TCFD exercise, it's not about telling companies what they must say, but it's helping them understand how they should report it if they are going to be disclosing this information. And both approaches are, important, equally important, but they have different audiences. And the TCFD and CDSB's vision, essentially it's a landscape where investors or other stakeholders have comparable, transparent, and consistent information from, all of their portfolio, so they can then make fully informed decisions. So where, these organizations have long-term visions, only the companies which are able to demonstrate the full picture of how they create value, will be attractive investment options. And this ultimately, which is a whole theory of change, will make the transformation to an environmentally sustainable business models more attractive investment opportunities, which in turn will help reduce the overall impact of the business world on the environment. And that's the whole exercise that we're going through here. So for anyone who's new to the sustainability reporting landscape, you may get lost in a soup of acronyms, and that's understandable because there are lots of initiatives out there. But actually, they all have their purpose within this landscape, and the TCFD's message is very clear. This is not about reinventing the wheel, and they actively support the majority of the main reporting initiatives. Here we've listed a few, and this is a tweet that they put out at one point: CDP, SASB, CDSB, TI, IIRC, and I'm deliberately listing them because there are many others, and you may still feel a little bit confused by all these different series of letters. So this is once again put quite simply, but this is how they all fit together. So the TCFD is what is currently getting the financial community to be talking about this subject. So TCFD and CDSB, they aim to get this sustainability topic out of, let's say, the sustainability teams, within businesses, and they want it to be recognized that, climate change is a risk or an opportunity, like any other risk and opportunity within a business, say a regulatory risk or another physical risk, and it should be understood by the legal, the finance, or the risks teams and integrated within the standard governance enterprise risk management processes. So it's essentially, it's to show that, this is not, just about, to go back to the earlier slide, the purely just a sustainability impact. It's also about what are the long-term financial impacts on the organization. So once you've kind of got all these people talking about it, you may not know where to start, and that's where CDP, for one of the acronyms, comes in, and the CDP questionnaire helps companies understand what to disclose and how to structure it. Then you have GRI and SASB, which can help organizations understand what is material to their organizations. And finally, you can use the CDSB framework to understand how to integrate all of this information in your annual report. So this is all, for people who work within this, I guess, this landscape and reporting landscape, it's very clear how, there's different roles for all of these different bodies and a different impact and a lot of value to all of them. But, with this all being very well, are people actually talking about it outside of our niche reporting area? And the answer is yes. So what I want to be talking about next is, what are the actions that regulators, investors, and corporates are already taking within the world. So first, to set off really the scene about what action is going on, I wanted to start by giving you an idea of the real momentum around this topic, and it is actually truly stunning, because a few years ago very few people were talking about this topic in the way that they do now. And back in December there was a huge conference which took place in Paris. It was dubbed the One Planet Summit, or the Macron Summit, and it was a call to action 2 years after the previous Paris COP summit, where the whole world, USA aside, agreed to take significant steps towards tackling climate change. And amongst the thousands of attendees, there were over 50 heads of states, from President Macron himself to Theresa May from the UK, and too many other large global business leaders to lead. But examples: Mike Bloomberg, Bill Gates, Richard Branson, to name some of the most known ones. And the message was really crystal clear, unanimous, and constant. And it was that disclosing climate-related risks and opportunities is critical to businesses. And throughout the whole, one of the big purposes of this summit was to make sure that anybody who was, I guess, attending, from a government or from a large international body would be making announcements. And throughout the 2 days, there were constant stream of announcements. So the significant amount of divestments happening away from carbon-intensive industries, that is gas and steam. I mean, the World Bank themselves announced that they would be divesting from all upstream oil and gas investments after 2019. And that was unforeseeable a few years ago. Another example, Climate Action 100 Plus, that's a coalition of 225 largest institutional investors, which are worth over 25 trillion. And that was launched to jointly push carbon-intensive firms on their climate actions. There were large investors like Vanguard, BlackRock, Aviva, who are some of the loudest proponents of the TCFD. They were continuing their engagement with companies to get them to disclose this material climate-related information. The Americas launched a carbon pricing initiative. China announced a roadmap for their environmental disclosure to 2020. It was constant, and the TCFD was left, right, and center throughout this. And in short, green finance is becoming mainstream. And as the French finance minister Bruno Le Maire said, the future finance must be green, or it simply won't exist. And that's quite a striking message, and not one that you would expect, the way that you would have expected a few years ago. And to this effect, regulators and politicians are helping and shape and drive progress and really getting the momentum behind this. My next slide, it provides a high-level overview of some of the regulatory developments going on, and the purpose is not for me to go through them detail by one by one, but these they show the breadth of global action, and this is all related to the TCFD or equivalent itself. And in the European Union, for those of you who've followed the regulatory developments there, they've got the European Union Non-Financial Reporting Directive. In France, they've got a leading piece of regulation called Article 173, and there's many other countries which are moving to endorse the TCFD and find ways of bringing them into regulation. In Australia, the Senate's Economics Committee, they recommended the adoption of the TCFD, while the Prudential Regulatory Authority, they have been working to get additional enhanced corporate disclosures. And it's worth noting that, even on this slide, but even more generally, these aren't all maybe what would historically be seen as the major or the most significant supranational bodies, and that's because within each country there's a lot of other bodies who can have a huge impact, like securities administrators, stock exchanges, or tweaks to investments stewardship codes, they all have roles to play. And, small amendments to, for example, directors' duties or other corporate duties can have a significant impact. And that is how, the world is shaping now, is that a lot of different organizations are looking for, different ways of moving the tide here. And just as much as regulators are providing some of the push, investors are also providing a pull. This is just a non-exhaustive list of some of the investment bodies who have recently made some statements about the TCFD. And I'm not going to touch in too much depth about investments because Sarah Barker will be talking about it later. But one example there, BlackRock, they recently asked their portfolio to report in line with the recommendations in high-risk sectors. It's also demanded from all of its portfolio board fluency on climate-related matters. In the UK, Aviva, which is a significant international organization, they've stated that they will be voting against companies that do not reveal their climate-related risks. And these are just two examples I've picked out, in view of being conscious of the amount of time to talk about it. But this is the new normal. This is what is happening globally at the moment. And on that note too, what are companies doing? Are they ready for this type of disclosure? And like everything, the answer is it depends. But we recently did an analysis, which we published in 3 weeks' time, of the company's readiness, globally for TCFD based on their responses to CDP last year, and if there are any geographical industry differences. And we looked at over 1,500 different companies in 15 different countries, and we could see that there are geographical differences. So, for instance, globally, there's 8 out of 10 companies that have board level oversight of climate related matters. In Europe, it's 9 out of 10, yet it's only 7 out of 10 in North America. And that, might very well be a reflection of the regulatory developments over the last decade that you have in Europe versus maybe the perceived litigation risks of disclosure in North America. And these, should have an impact in terms of how investors and stakeholders are assessing how, prepared, from a governance and a strategy perspective, the organizations are. So similarly, 90% of companies, they disclose that they integrate climate-related risks and opportunities in their strategy, but only half of these are considering them in the medium and long term. So that should make an investor maybe reflect on how many, of these opportunities are opportunistic rather than strategic. Potentially. And going back to the first point around the fact that 80% of companies have got board level oversight, but fewer than 2 in 10 are offering incentives to their board members to take action against managing climate change. So you can see that action is still lagging a long way behind ownership. And finally, one of the these are the 4 on the left is the 4 thematic areas of the TCFD, and the last one is around metrics and targets, and it's focused very much on carbon emissions. And the good news is that almost 90% of companies disclose the carbon emissions which are required for by the TCFD, but there are still significant geographical variations, and you can see in China, as illustrated there, only 7 out of 10 companies do too. And taken individually, these are just some 4 out of, well, maybe not quite 100, but dozens and dozens of different findings that we've had. And taken individually, these are all relatively anecdotal facts, but put together, it does paint an interesting picture, of what the global readiness is. And I would like to invite you to keep an eye out for our report, which will be coming out mid-March, because there's a lot of interesting insights there in terms of what what companies are doing and how they are approaching managing the climate-related risk and opportunities. So with that, I will hand back to Karen, but please do ask questions if you want, and we can answer them at the end when we have time.
Thank you, Simon, and thanks for that, giving us a great introduction and some broad oversight as to what's happening in the international space and where we're at from a local perspective, I would now like to welcome Sarah Barker, who's Special Counsel at Minter Ellison. Sarah's work is at the forefront of international developments with institutions from the Bank of England, the United Nations PRI and the European Union, allowing her to provide practical, progressive advice to listed corporations, investors and government agencies in Australia. She's an experienced director, currently sitting on the board of one of Australia's largest superannuation funds and the Responsible Investment Association of Australasia. She's also taught the Australian Institute of Company Directors CDC course for more than a decade. Welcome, Sarah.
Thank you, Karen. Today I'm going to talk about the regulatory environment in Australia and how the TCFD recommendations fit there. Because one of the common comments that I get from boards of directors and finance and accounting teams in relation to the TCFD is, it's voluntary. Come back and talk to me where there's some legislative requirement that we have to take climate risk into account. And my response to that is, it's already compulsory under the existing corporations, securities and commercial laws that we have now. Now, the reason for that is that climate change is a material financial risk within mainstream investment horizons. Now, I take a very purist view on things that are relevant to companies. I'm a corporate lawyer, so none of that bleeding heart, lefty greeny, pinko, hippie environmental stuff. I take a very purist view on the fact that relevance is a financial issue and materiality is a financial issue. So to me, the two questions that we need to ask and that we need to deal with when we're looking at the relevance of climate change risk and the TCFD to our mandatory reporting framework is twofold. So first of all, is it mandatory for business to have regard to climate change related risks? And there we have to look at whether or not it's financially material in a governance, strategy and risk management context. So in looking at that question, we're thinking about, is this something in an advisory context that you should be talking to your clients about? The second question, is it mandatory for business to disclose risks associated with climate change? And there we're looking at whether or not the issue is material in a disclosure context. And they're two very different questions, but the answer to both is yes. So next slide, please, Denise, and we'll look at those questions. Next slide, please, Denise. So first of all, looking at the financial materiality of climate change and its relevance to boards. Back one, please, Denise. So, is climate change a material financial risk over mainstream investment horizons? If the answer to that question is yes, then of course boards of directors have to consider it. Now, in October of 2016, this was the question that was asked of a very senior barrister, very senior commercial barrister, Noel Hutley SC, the head of the New South Wales Bar Association, not particularly known for any environmental or social views. And the question that was asked of him was that, would a court consider that climate change is a risk that directors now need to take into account? And the answer to that was yes. His view was that yes, it is compulsory for directors to consider any issue that is reasonably foreseeable to impact on financial performance or prospects. You can't actually determine whether or not a particular issue has a material impact on your business until you've thought about it. So his conclusion was climate change is definitely an issue that has reasonably foreseeable financial impacts for business, not just environmental impacts. And the kinds of impacts that climate risk has through a financial lens include not only policy and regulatory risks, but technological risks that can shift very quickly. Things like the electrification of vehicles and autonomous vehicles and the relative competitiveness of renewable energies. And finally, stakeholder risks. The risks involved in your customers, the millennials, and regulators changing their views and their demands in relation to climate-related risk. So Mr. Hutley's conclusion was it is an essential part of directors' due care and diligence to take climate-related financial risks into account. Last year, that was then picked up by the Australian Prudential Regulation Authority, APRA. And Jeff Summerhayes, one of the commissioners, in 2 speeches, picked up on Mr. Hutley's opinion and explicitly stated that APRA expects directors of its regulated entities, which are banks, insurance companies and superannuation funds, to assess climate-related risks to their businesses and to stress test them against the goals agreed by 196 governments across the world under the Paris Agreement. And that, of course, is the goal that all these countries have committed to introduce policies that seek to limit climate change to an average temperature increase of no more than 2 degrees above pre-industrial averages. And that was also mirrored in the annual report of APRA, where there is an explicit statement in 2 places in the APRA annual report where they emphasise that they are going to be requiring and emphasising climate change as a material financial risk when it's reviewing the governance and disclosures of financial companies. So I think it's very safe to answer our first question in the affirmative. Do businesses have to take climate change into account as a material financial risk? Yes. But what does that mean for you in a financial reporting and disclosure context and in your auditing context? Next slide, please, Denise. And again, that comes down to this question of materiality. To put reporting obligations at a very base first principles level, and this includes the obligations that apply in New Zealand as well as Australia, disclosure obligations require that a true and fair view of performance, financial performance and prospects be given. Now, you only need to disclose what is material. Now, it's not a matter of just running a financial ruler over things and saying, oh, is it worth 5% of revenue, yes or no? That's how we know if it's material. Materiality is a far more qualitative context, and this is true all around the world under any company that's governed by or takes into account IFRS standards. So the actual test of materiality is, would a reasonable investor consider the information decision useful? So for your purposes, that's the question we need to answer. It will be material if a reasonable investor will consider the information decision useful. So let's look at the answer to that question. Next slide, please, Denise. So what information are investors currently requiring? Are they requiring disclosure of climate-related financial risks? Next slide, please, Denise. This is the man that you need to be very afraid of in a disclosure context. It's not Donald Trump. This man is Larry Fink. He looks very friendly. Larry is the most powerful man in the world. Who is Larry? He is the CEO of BlackRock. And as Simon touched upon, BlackRock is the largest investor in the world. BlackRock has more than 5.6 trillion US dollars worth of assets under management. It's more than 3 times the size of our entire superannuation sector. On average, BlackRock owns nearly 8% of every listed company on the planet. That's how big BlackRock is. And so when Larry says jump, companies need to say how high. Next slide, please, Denise. So does Larry want disclosure of climate-related financial risks? And the answer to that is absolutely. For the last number of years, in his annual letter to the chairs of companies in which BlackRock invests, they have demanded information in relation to how companies assess and strategize around climate-related financial risks. And as touched upon by Simon, last year they said that they were going to talk to all the non-executive directors of the companies in which they invest, and if they weren't satisfied that those directors had demonstrable fluency in how climate change impacts on their business as a financial risk, they were going to start voting against them. And the same can be said from all those investors you can see on the screen, which are all the largest investors in the world. Vanguard has nearly $5 trillion worth of assets under management itself. Not only that, both the large credit ratings agencies, Standard & Poor's and Moody's, have expressly indicated that they are taking climate change as a financial risk into account in their credit ratings. Next slide, please, Denise. So the answer to our second question, is climate change as a financial risk material from a disclosure perspective? Would a reasonable investor consider the information decision useful? And the answer to that question is absolutely. This isn't a fringe investor environmental activist issue anymore. It is clear that large mainstream investors want this information to be disclosed. Therefore, it is material. Therefore, it needs to be disclosed. Next slide, please, Denise. Just to finish up, just wanted to talk about what that means for you. Stress testing and scenario analysis are the key to material disclosures. This is one of the big parts of the TCFD recommendation that I know Paul is going to talk to you about in more detail. Stress testing and scenario analysis around climate risk are the tools that are used to account for the huge range of uncertainty in relation to, well, what climate future are we going to have? So it's not a matter of picking a single point and placing all your bets on that point. It's about asking, what if this happens? What if that happens? What if the Paris Agreement commitments are implemented? What does that look like for our business? What if we have rampant runaway climate change? What does that look like for our business? And that is particularly important, next slide, Denise, for you with your auditing hat on. Because, of course, you have obligations around professional skepticism. You have a professional obligation to be asking the what if. And if there is an issue in which companies around the world have failed to keep on top of this issue and almost universally failed to make projections that are consistent with climate change as a material financial risk, it is climate change. And that really does enliven your obligations in relation to professional skepticism when you are auditing accounts. Next slide, Denise. In the few minutes I have left, I just wanted to talk about why this is not just a theoretical risk. We are actually seeing a significant number of cases against companies, against directors, and against their auditors being filed in relation to the misleading disclosure around climate-related financial risks. And the reason for that, again, is not because people's environmental consciences are being activated. Next slide, Denise. There's this great saying that I absolutely love from Miles Allen. Even the most impassioned eco-warrior has nothing on a homeowner facing negative equity. When people lose money, they try and blame someone else and they try and claw back their money from someone else. So the reason that we're seeing so many cases now being filed is because people are starting to lose money or are concerned that they are going to lose money and that they're trying to chase their losses. Next slide, please, Denise. So we're seeing there a proliferation of reports on how litigation is influencing the transition to a lower carbon economy. Next slide, Denise. I won't go into those in the interest of time, but what I will quickly touch on are the cases that have been filed so far. So we're seeing a number of claims all around the world by shareholders and beneficiaries, by regulators, and by governments. So there are cases here in Australia. You would have seen last August where shareholders filed a claim against the Commonwealth Bank alleging that their 2016 disclosures on climate risk were misleading. In the US, just picking out selected examples there, where we've got the Securities and Exchange Commission and State Attorneys General investigating Exxon and its auditors in relation to whether or not their disclosures of climate-related financial risks have been misleading over a number of years. Now, the Securities and Exchange Commission is not a greenie body. That is their ASIC. And we also have now tobacco-style claims by 8 local government areas against larger coal, oil and gas companies and their directors, alleging effectively that because of their misleading disclosure of climate risks, that those local government areas are suffering loss in the form of requirements to spend a lot of money to upgrade infrastructure assets against the impacts of climate risk. Next slide, Denise. So that's all I wanted to talk about. I know that there have been quite a few questions come through. I have noted those down. In the interest of time, I'll hand over to Paul, and then perhaps at the end, if they're not covered by Paul, I can deal with them in the question and answer session.
Lovely. Thank you, Sarah, very much. And thanks for that excellent overview of the sort of legal and regulatory space. And as Sarah mentioned, we'll get to some of those questions at the end if Paul doesn't cover some of them in his presentation. So I'd now like to welcome Paul Dobson. Paul is a partner and Asia Pacific leader for sustainability services at Deloitte, with over 15 years of assurance and advisory experience. Paul has extensive experience working with complex sectors, including energy, mining, manufacturing, and property, with a particular focus on carbon, energy, and sustainability services. Welcome, Paul.
Thank you, Karen, and good morning, everybody. So I'm pleased to share some more insights into the TCFD. So now I'll work through the recommendations to share what exactly the TCFD is saying. So this slide on the screen you have seen before. Simon showed it up, and it's one of the best ways to describe exactly what the TCFD is focusing on. And what it is telling organisations is to work through and make the link from climate-related risks and opportunities, consider them as part of strategic planning and risk management, and assess what is the financial impacts and then disclose that. It looks simple, but it's not. And that's because climate risks and opportunities are complicated. It's not necessarily just focused about your own emissions. It's some of the broader risks from climate change. And it's different for every organisation, whether you're in banking or energy, and it's different depending on the sector. So it is a process to work through, but importantly, the TCFD is asking organisations to embed this into their existing processes, particularly in the strategic planning and risk management. It's not about creating an entire new TCFD related process. It's about implementing and embedding this risk assessments around climate risk and opportunities into your existing processes. If we could go to the next slide, please, Denise. So, you'll have heard us today talking about climate risks and opportunities, but what are climate risks? This table in front of you highlights some examples of climate risks and what some of the potential financial impacts are, because the TCFD, again, is requiring companies to make the link to the financial impacts. So if we look at these first, you've got transition risks and physical risks. Transition risks are focused around changes to policy and legal environments, such as increased greenhouse gas emissions pricing. We had a carbon tax in Australia previous years that made organisations think about increased costs where they had high emissions. that's likely to happen again in our jurisdiction or others around the world. So that's something to think through. What does that mean for your financial context? If we look at technology, costs to transition to lower emissions technology, there's a financial cost to that. That needs to be considered. We have market changes. Consumers are changing their behavior. What does that mean for your products and services? Reputational shifts. There's lots of examples of increased stakeholder concern or negative stakeholder feedback on various issues. What does that mean for production capacity? Does it delay your approvals around investments? And what does that mean financially? So these are some of the transition risks that you would consider as you're considering TCFD and thinking through, well, where do these impact you in your financial statements and your financial planning? We also have, of course, the physical risks. Acute weather conditions, increased cyclones, floods, etc., as well as changes in mean temperatures. And that means potentially increased insurance premiums or reduced availability of insurance in high-risk sectors. So these are taking the climate risks and linking them to the financial impacts, which is what TCFD is asking all of us to do. Next slide, please, Denise. But it's not all about risks. The TCFD also asks organisations to think about opportunities. There are many examples of opportunities where looking at climate change from an opportunity lens, such as through increased resource efficiency, changing to the energy sources used to power electric appliances, etc., can result in opportunities for business. It could mean looking at new products. It could mean reduced costs through efficiency gains. So there's definite upside as well as the downside. And climate change has often been considered through a negative perspective or through a risk focus, but TCFD is asking organisations to consider both risks and opportunities. There's potential for access to new markets. There's increased incentives to change over time in new products, financial assets such as green bonds and infrastructure, all examples of where organisations can focus to look at on the upside as well as considering and managing the risk-related side. So TCFD is all about linking these risks and opportunities into the financial consequence and the financial processes of organisations. So if we move forward, Denise, to the next slide, and we can look at the actual recommendations of the TCFD. So the framework has been developed into 4 areas. We have governance, strategy, risk management, metrics, and targets. So if we take governance first, it's about describing how the organisation manages and governs climate-related risks and opportunities. It's important that it's been focused on the board oversight. Given the discussion we had earlier with Simon and Sarah, it's seen that obviously this is a key risk for organisations. Directors need to consider it. So therefore, there should be strong governance and board oversight. So organisations are expected to describe the oversight of climate-related risks and opportunities, and particularly that would be within the broad framework. Wouldn't expect that companies set up a separate board committee for climate risk. It would be part of their existing, whether it's audit committee or other committees or the full board itself. The framework also recommends that the way management manages and assesses risk and opportunities is described in your frameworks. We have strategy. So what does that mean? So companies need to disclose the actual and potential impacts of climate-related risks and opportunities on the business strategy and the financial planning where it's available. So that means identifying those risks in the short, medium, and long term. And then describing both qualitatively and quantitatively what the impact of these risks and opportunities are on the strategy and on the way financial planning is done in the organisation. And Sarah mentioned the impact of scenarios. So scenario analysis is taking a number of different scenarios or assumptions and assessing what does it mean for us as an organisation and what are those financial impacts. That can be quite a challenging area, but it's stepping through, and many organisations right now are doing that on part of their portfolios as pilots to assess what does that mean and developing these over time. But effectively, it's trying to take some of those risks and opportunities that you've identified and working through to see what is the financial impacts likely to be on our organisation. There's a risk management focus, and this is important because part of the governance of an organisation is ensuring that there's appropriate risk management processes. And the TCFD asks companies to disclose how the company identifies and assesses and manages these risks. And that would be embedding it into existing risk management framework of an organisation, but ensuring that these climate-related risks are considered and embedded and then described. Then we have metrics and targets, and we all know that if it's not measured, it's not managed. So therefore, the framework recommends that companies disclose how it manages these risks and opportunities, where it's material. And that's an important point because not every climate risk, and those ones I went through earlier, are material, and that's an assessment process that the company needs to work through, but where it's material, it should disclose how it measures and manages those. And those recommended disclosures include these emissions, and Simon mentioned that most companies are disclosing emissions right now, but also when you're looking at some of the more broader risks and opportunities, there may be other metrics that you'll need to incorporate in order to demonstrate how you're managing those. But the key point is I recommend that you don't look at this as an entire new process. I would look at TCFD as a way to embed climate risk into your existing governance strategy and risk management frameworks, and then develop metrics and targets to manage those as that works through. Next slide, please, Denise. We mentioned disclosure, and the TCFD is all about disclosure. But importantly, you can't disclose until you've worked through and done your process. However, as we've seen, and I'll go through an example in a moment, companies are starting to look to TCFD and starting to disclose what they're doing. I think that's very important. But fundamentally, the task force recommends that these climate-related financial disclosures that we've just been through are in the annual financial filings. So that would typically be in Australia and New Zealand, the annual report. And where in the annual report is a question. It could be part of the OFR potentially in Australia, or it could be part of the disclosures in the ASX and New Zealand stock exchanges around governance relating to sustainability. But fundamentally, it's really about, it needs to be in the public financial filings in order to demonstrate the link and the thinking to the financial impacts. And I think it's fair to say that companies are still experimenting. There's only been a few that have come out with TCFD disclosures, and I think people are working through where they see that best fits, but it's important that it's in the annual filings. The task force also says that the governance and risk management aspects, they should be included within the annual filings, and they don't really have a materiality lens because given that climate change is an important risk that needs to be managed, there should be a governance process and a risk management framework in order to identify those material impacts. So it's expected that there is disclosure around governance and risk management, whereas when you're talking about strategy and metrics, where those impacts of climate risk and opportunities are seen as material, then you would disclose the strategy and metrics and targets aspects. So that's where materiality comes in from a disclosure perspective, primarily around the strategy and metrics and targets recommendations, as opposed to the governance and risk management frameworks. And importantly, the task force believes that there should be appropriate internal governance processes around these disclosures. And that's why it's recommended it needs to go in the annual financial filings, because they're subject to board and audit committee oversight in most cases. So it needs to be at the highest level in order to for companies to demonstrate and directors to demonstrate that they are across their obligations. The framework also focuses on particularly some key sectors that it sees as important. So financial sectors, there's additional guidance for banks, insurance companies, asset owners, and asset managers, and that provides insight into additional risks and where these issues may be manifesting. There's also guidance for non-financial sectors, and these sectors listed here are those that are considered to be the most impacted from a climate change perspective. So I encourage you to have a look at those. Next slide, please, Denise. So I just thought I'd share some examples of what organisations have been doing in the climate risk space. The first one here is ANZ Bank. And they released their annual review in November, just last year, and they had disclosures around TCFD. And they said that they're applying the framework, and that was included in the annual review. And then they also added additional information in their sustainability report. So they referenced the sustainability report. So ANZ was one of the first organisations in Australia to disclose, and they outlined their governance, their strategy, their risk management processes, as well as it talked about where they had started to look at different scenarios. And important to note that their scenario analysis was on some parts of their portfolio, and that they were moving forward with that over time. And I'll come to that in an implementation pathway in a moment. The other two examples I've got there, BHP and AGL, they're two very large companies who are in those sectors that are expected to have the most impacts from climate change. And they actually released some disclosures around scenarios and assessments of climate risk. They predated the TCFD, so they were in 2016, both of them. And that demonstrates that these organisations were thinking of these risks and sharing to the market. These were separate reports. So these organisations are now obviously working through the TCFD recommendations, but it is interesting to see that there were a number of them that were talking about these issues predating the TCFD. And then this coming reporting period up to June, it's expected that more companies will be starting to disclose what they're doing around TCFD. And many of my clients are starting to digest the recommendations and look at how do they implement and then report to the market. So if we go to the next slide, please, Denise. So if we look at, okay, how do you do this? Fundamentally, I've just outlined a very high-level roadmap, but effectively, it needs to be a staged approach. As you will have seen, the risks can be quite complex. They're different for every organisation, different for every sector, and it's about understanding where they manifest for you and your organisation within your business strategy and your risk management frameworks. So the first step would be to conduct a high-level impact assessment. So that would typically include a gap analysis against the framework to understand how far are you away from some of these aspects within the disclosure recommendations, as well as working through and identifying what are the most key risks and opportunities for your organisation, and looking at how do you implement a governance framework and embed these into your strategy. You would then typically take those risks and opportunities and start to consider what are the financial impact assessments and the financial impacts, and consider scenarios. So that's where you are taking these risks and putting through different assumptions to see, under a 2-degree world, what does that mean? And it's important to call out that scenarios are not necessarily quantitative. They can be qualitative or a combination of both, because this area, it's very hard to predict what the world or what the impact will be under different assumptions. So describing it in a narrative way around scenarios is just as important as the quantitative, but fundamentally you're trying to understand what do these different risks and opportunities mean for your strategy and therefore your financial outcomes. Once you've been able to consider some of the key financial impacts, you would then look at, well, how do we continue to manage the issues? Some companies have targets already, as Simon indicated in his earlier presentation, but these would need to be refined and defined, as well as consider what metrics are there. Most companies now report their greenhouse gas emissions, but that won't be enough to manage some of these risks. So you would need to work that through once you've identified what are the key risks and opportunities and where do you think the financial impacts are going to land. And then, of course, you need to align with your disclosure framework. And it's important to say that you don't just wait to the end to do that. You should, as the arrow underneath indicates, keep the market up to date as the framework is adopted. So if we go back to the ANZ example, ANZ has outlined how they've adopted the framework, but they've also acknowledged that they're doing more work in certain areas. So that is the way to disclose to the market right now, is that you're on the journey to adopting TCFD, and this is where you're up to, and this is what you're going to do, because you don't want to say nothing that isn't helpful to the investors, but equally you need to make sure that you work through the framework appropriately in order to disclose. So it would be an ongoing process that you continually update. And fundamentally, once you've implemented TCFD, these risk and opportunities should form part of your strategic planning and your risk management processes going forward, so that these disclosures and the outcomes become part of the day-to-day organizational management. So in summary, just conscious of time, the TCFD, it's about linking climate change risks and opportunities to financial impacts. It is voluntary, but as Sarah said, it's expected. It's being market-led. The framework is complex and implementation will take time, but encourage organisations to start now. Consider where these risks and opportunities are likely to manifest the most, and start doing those assessments around scenarios and considering different angles earlier now, and ensuring that the discussion is had within your organisations. So I'll leave it there and pass back to Karen to sum up.
Great, thank you very much, Paul, and for giving us that slightly deeper insight into what the TCFD recommendations are proposing. Now, obviously, just to explain, the TCFD recommendations were only published in June 2017, so I know one of the questions was asking about adoption, and as Paul's indicated, adoption is still at the early stages as the recommendations are fairly new, but we're certainly seeing quite widespread support for them. So just moving on, Simon's just going to provide a little bit of an overview as to a knowledge hub that's coming soon from the TCFD.
Thank you, Karen. And as I'm very conscious of time, I will be very quick. In short, CDSB, in collaboration with the task force themselves, we're creating an online encyclopedia platform for the TCFD recommendations, which we'll be launching in April of this year. It's meant to be a online database with all the standards, frameworks, guidance, other useful materials for organizations or investors who want to find out information about the task force. So you may be someone who knows a lot already and are looking for a specific piece of information, for example, the concept of materiality in the telecommunications company in New Zealand, and there'll be a search engine you can use for it. Or you may know very little about the recommendations, and then the platform will take you through across the 4 different thematic areas to help you identify the resources which are useful to your process. So please watch this space. It's going to be one of the biggest, I guess, exercises over the next few months with regards to TCFD that's going to get published. So there'll be a lot of noise, and hopefully you'll pick up on it when it gets published in April.
Thanks, Simon. Next slide, please. And just a bit of a plug for the World Congress of Accountants, which will be taking place in Sydney in November. That's being hosted by Chartered Accountants Australia, New Zealand and CPA Australia. And we will be covering some of the themes that have been covered, or I guess extending some of the discussion that we've had in today's webinar. These kind of themes such as sustainable outcomes and looking at forward-thinking, how forward-thinking accountants can save the world, and these kind of concepts, SDGs and so forth, will be covered in that conference. So please join us if you can. Now, we've got a little bit of time for questions, so I will get in there straight away. So, Simon, what impact does President Trump's stance on climate change and dismantling of the EPA have on reporting?
It's a good question. I think the full answer is that it will slow down things more so than if the administration had been fully supportive of global action on climate change. But from a practical perspective, there's a lot of action and regulation which is driven at state and city levels in the US. So if anything, or the administration's stance has actually galvanized a lot of action in the US. So it's an interesting situation where we are still monitoring what is happening. Clearly, the role of EPA is different now to what it would have been a couple of years ago. But from a corporate perspective, there's still a huge amount of action, and actually because this is not an ethical or moral question. This is that we're addressing it as that is part of it, but it's also a financial question, and the companies are aware of what the financial risks and opportunities are, and as such, they want concerted action on this, and they're moving forward with it.
Thanks, Simon. Another question was around why have we mentioned APRA and not specifically ASIC? So just to cover off on that one, which I can actually answer myself anyway, ASIC are looking at this in the sense that they put out every reporting season their areas of focus for that reporting season. So certainly in their release in May, they mentioned specifically wanting organisations to consider in their operating and financial review material risks, and they mentioned climate change and cybersecurity as two key risks. So in terms of that, we are definitely seeing that ASIC are taking this quite seriously. We also know that ASIC, APRA, Treasury and the Reserve Bank of Australia are all also meeting to look at how climate change will impact and what they can do to, I guess, progress that. So certainly that is moving forward, and it's certainly not the case that ASIC are not doing anything in that space. In terms of, we've got another question around there would be potential risks and opportunities creating financial impacts from other sources that are not disclosed in financial reporting. So what makes climate change different? Sarah, did you want to cover that one?
Sure. I don't think climate change is different at all. The TCFD is really about dragging climate change up to have the same status as any other material financial risk or opportunity. I think historically in Australia, in particular, the way that climate change has been positioned has been a political issue. It's been kind of shouted from the polls between environmentalists and business people, and there's been a presumption that there is an inverse relationship between action on climate change and financial outcomes. That has shifted. That has shifted 180 degrees. So it's really just changing the mindset to think, okay, we need to treat climate change on a par as any other financial risk issue. A little trick that I often use is to substitute the word cybersecurity for climate change, which often helps boards in particular and preparers of financial reports shift that thinking around climate change as a financial risk. I should point out, though, that the World Economic Forum has had issues related to climate change as more than half of their top 10 economic risks for the last 3 years. So even though we're saying it should be treated on a par with any other financial risk, you shouldn't underestimate the relative significance of climate change as a financial risk.
Great, thank you, Sarah. I think when I looked through most of the questions, we have covered most of the key points that were raised. One question was in relation to disclosure, and does that mean that the financial filings, or could there be other mechanisms for disclosure to meet the obligations? Paul, did you want to answer that one?
Yeah, no, thanks, Karen. And I think the recommendations are around the annual financial filings. So there is nothing wrong with putting some summary information in the annual financial filings and then referencing to additional disclosures. But it's important that it is in the filings that have the oversight of the highest level of governance, so the board. Because it's recognised that there are some other disclosures that meet the public domain that may not have had the same level of rigour that goes through, say, audit committee or board committee. So that is the key angle where the TCFD is coming from. But I think something in the annual report is what is recommended. But each organisation will need to consider that as they work through their own disclosures.
Just to augment that, if it's financially material, it has to go in the financial report. Full stop.
Yes.
Whether it's in relation to historical performance in the financial statements or in relation to prospects in the director's report. And there are obviously specific legislative requirements for material financial risks to be specified in director's reports. There have actually been a couple of cases in the UK where companies who've disclosed climate-related financial risks in their CDP questionnaires but omitted to replicate those in their annual reports have been prosecuted for misleading disclosure. So you've got to be really, really careful not to rely on the fact that you have, say, a sustainability disclosure that isn't linked to your financial report.
Thanks, Sarah. Now, I know we're a little bit over time. We do have just one more question, so I will just put that to the panelists and then I will wrap up. It says the challenge around scenario analysis is to make these comparable and relevant to investors. What's being done in this space? Over to anyone.
Yeah, I'll start. So it's a good question, and it's about, so I know organisations are working on developing some tools, and Simon shared that there will be some additional tools coming out from the TCFD, but in the absence of tools, it would be about ensuring that you disclose what your key assumptions are as you are developing them, and it will be refined over time. But I think it is a watch this space process. But as you do it, consider it in your own organisations, it would be really important to confirm and disclose what your key assumptions are as you work through your scenarios, and then when you get to disclose what the impacts are. Simon, is there anything to add?
Simon?
No, sorry, I was on mute. No, I think that's a very comprehensive answer.
Great. Well, then it's just over to me to say thank you very much to Simon, to Sarah, and to Paul for their time and contribution in sharing this topic with so many of you today. And I'd also like to particularly thank Denise for her assistance in running through the slideshow and all the sort of logistics involved in getting this set up, particularly moving everyone onto the new platform when we had so many people register. The slides and a recording will be sent to you afterwards. I know a number of you have asked, so that will be sent following the session. And we would welcome your feedback as well on both the webinar and whether you enjoyed it, whether you found it useful, and also whether there's anything more on the topic that you would like to know. You can send this through to the info@cdsb.net email address that you'll have received some of the emails from, or the future Inc at charteredaccountantsANZ.com address, or you can send things directly through to me. So thank you very much and enjoy the rest of your day.